Yeah, let's go ahead and get started. Well,
Let's
thank
kick it
you all
off.
for coming. I'm Jim Oliver, and on here also, who's about ready to enlighten us with a lot of great information, is Justin Kraft. And Nowlin and Associates and Create Tailwind are really excited to do this meeting and share the information that we have teed up for you guys. So with that, I'm going to turn it over to Justin, and he's going to kick this meeting off. Justin?
Well, first, let me again welcome you all here. Jim, I really appreciate you being on here together. And Jim and I both are really excited about the information we want to share with you this evening. Obviously, it's been a long 3, 4, 5 weeks, just depending on what part of the country you're in. And through this time, I can tell you, Jim, as a financial advisor, having done this, managed money for 21 years now, I don't think I've ever seen a time when there was more confusion, more just a lack of guidance, and candidly, just a lot of concern in and amongst the economy. I went through 2000 and 2001 with 9/11, the Great Recession, obviously, which was much more from a financial cause, and then today. And I will tell you, there's similarities to all of them, but it's really unique. And one of the things that I wanted to share with you that Jim and I, we happen to be on a call having a conversation together, is we really wanted to share with people the hope and the opportunity that is out there. Through every crisis, there is always opportunity, but you have to be willing to think just a little bit differently. And if you look at my screen, one of my favorite quotes is up there from Albert Einstein: "We cannot solve our problems with the same thinking that we used when we created them." And I think that is so true today, Jim, as much as ever before, is that we really, in order to recognize opportunity, we really have to change our thinking. And my mentor and yours, Jim, has always told me that once you truly understand the problem, the solution becomes very, very simple. And so our objective tonight is to share with you a couple of the problems, but also give you some practical advice and some solutions that you can take action on to prepare yourself and your family as we come out of this into a recovery, so that you're prepared to take advantage of the opportunities that are out there. So without further ado, let's get going. So again, we've got to understand the problem. And Jim and I were talking, one of the things that I really see a lot is that people are making decisions based on information that may have been accurate 10, 15, 20, even 30 years ago. But what has happened today is that the variables have changed greatly. So maybe we were investing money in retirement plans because of the old adage, hey, you're going to retire in a lower tax bracket. But what we'll find is maybe that's not the case. And if you knew that that wasn't the case, would it change the decisions today? And the answer to that is a lot of times it would. So I like to show this as an example to show you that in this new economy, as we call it, the variables of the economy have changed greatly just from 1990 and 2000. Back in 1990, the prime interest rate was around 10%. Well, today it's as cheap as it's ever been. It's 3.25%. Our population, because of the great baby boomer generation, there are over 95 million Americans aged 55 and older, where just 20 or 30 years ago, it was about 45 million. Jim, people are living longer today. So their money has to last longer for them. The life expectancy in 1990 was 75. Today, for a female, it's 86 years old. For some of us guys that are out there, it's only 83 and a half. So it's a little bit different. That's according to Social Security. You know, in taxes today, the highest income tax bracket today is 36%, where in 1990 it was 31. And Jim, you and I both know that that's projected to go up in 2025 when the Trump tax cuts, when it changes again and they sunset, it's going to resume and go back to the 40% as the top bracket. And then one of the biggest things that concerns me today, Jim, is when we look at how our federal debt has really accelerated. So it's over $23 trillion with a T And Jim, that's just going to continue to grow. And so for you guys out there, understanding the strain that that puts on us, and I wanted to go through just a simple example, just to show you that, and to help us understand how our decisions today can impact where we are financially tomorrow. So I want to show you guys just, I call it a family balance sheet. And so walk along with me. There's a family out there in our country today earning $36,000 a year. But when we dug a little deeper, we realized there's a big problem. They're spending $47,000 a year. So right away, that really jumps off the page at you. But when we dig deeper, we realize that they have $230,000 of revolving debt. So we see the problem right now. We're bringing in income that doesn't even meet the expenses we have, but we've got revolving debt. We got a big hole that's over $230,000. And I ask people all the time, how do you solve this problem? What is the one thing you can do that can make a difference? Obviously, we would like to cut spending. But again, even if we cut spending by more than 35%, it would just be breaking even, and we couldn't even make a dent in the debt. And so the number one thing people say, obviously, is file bankruptcy. But let's assume that that's not an option, because I think each and every one of you know exactly who we're talking about here with this example. If I add 12 zeros, you'll see that this was the federal budget in 2019. And I rounded the numbers. We brought in $3.6 trillion of revenue. We spent $4.7 trillion. And of course, we started the year out. This is before all the CARES package and the stimulus and all the things, the recovery that's going on now. We were already $23 trillion in debt as a country. Now, you might be sitting there saying, Justin, why are you telling me all this? I kind of already knew it. And so I tell you this because, again, I go back, we've got to understand the problem before the solution can become clear to us. And the biggest problem here, and Jim, I'm going to ask you this question and put you on the spot. The only way out of this is we've got to raise revenue as a country. Just like that family, that guy that was making $36,000, he's got to get a second job or get a better job that earns more income. Well, as a country, as a U.S. Treasury, how does the Treasury increase revenue?
They have to increase income. And so what they do is they got to tax us, right?
That's right, man. So the way that the country increases income is through taxation. Yep. And so I usually pause right here and I always ask the question, and I've given talks all across the country to thousands of people, and I've only had one person ever raise their hand and say that they didn't think so. I ask people all the time, based on the knowledge you have now, do you think taxes are going to go up or go down in the future? And the obvious answer is they have to go up, Jim. Right. And this is just a great little picture that shows that the average tax rates over history, the highest marginal rate was over 58%. And today we know we're at 36, and that's going to sunset and go back to 40 if I can round. So we know that taxes are heading up. That one fact alone makes a tremendous impact in what we do with our savings dollars. And there's a gentleman, several of you heard the call, and Jim, I think you were on there a couple of weeks ago, Mr. David Walker, who's the author of the book, Come Back America. And in his book, he made a prediction all the way back in 2010 that if there wasn't significant fiscal reforms in our country, if things didn't change, that taxes could easily double by 2030. I like to tell people, you know, it's one thing, Jim, for you to say it or for me to say it, but who is this guy, David Walker? Well, he happened to be the Comptroller General of the United States for almost 10 years under Clinton as well as Bush. What that means is he was the CPA. He was the accountant for our country. He was the head accountant. And David Walker also served as a trustee of Social Security. He's been involved with the congressional budget office. The man understands the numbers. And when he makes a statement like that, in fact, on our call, he said it could be sooner than 2030 because of all the spending and where we are from an economic standpoint right now. And so that's important for us to understand, because what it does is it makes an impact, Jim, in where we park our money. And so I want to start moving into our wealth has to reside somewhere. And so if you simplify it, there's only three places we can park money. We can park them in taxable accounts. These are things like your savings, your CDs, your money market. Maybe you've got a brokerage account that's not a retirement fund. Or we can store them in tax deferred vehicles. We call them tax tomorrow. These are your IRAs, your 401ks, real estate. A lot of our retired clients might have annuities. These are things that are taxed in the future. So I want to ask you a question. I just want you to think about it for a second. If you knew you had to pay a tax, because remember, we can't get away from death and taxes. We knew we had to pay a tax. Would we rather pay it in a lower bracket or a higher bracket? So even being from Alabama, I can even get that question right, Jim. What I want to do is I want to pay the tax in the lowest bracket I possibly can. And then there are some opportunities for taxes where they are tax-free. We don't get to say that often. Obviously, Roth IRAs will allow you to do that, but a lot of the clients we work with phase out on those and aren't able to participate. But if you are, great. And obviously, we don't want to park it in your safe. But another area that has become extremely popular in the last few years, as long as they're structured right, are properly designed life insurance contracts. They actually have, I think it's 7702, Jim, in the tax code. They actually have preferential tax treatment as long as they're structured properly. And so if we know we've got to pay a tax and we know that the variables have changed as we look at the new economy, maybe we want to understand that we shouldn't defer every dollar we're investing or saving into accounts that are going to be taxed in the future. Or maybe we shouldn't save every dollar in an account and pay tax on it year in and year out. Just by understanding taxes, we can increase the return and increase the net dollars we have just by understanding how to use tax advantage accounts. And so that's one of the areas I'm looking forward to diving into a little bit as we move forward. So it's hard to make us an expert on everything, Jim. And I tell people all the time, you know, this environment has made people think much more than ever before about understanding the difference between savings and investing. And so if you don't get anything off of this call, I hope this is one of the points that you take away, that there's a really big difference between your savings dollars and your investing dollars. So by definition, savings is money that you can't afford to lose or you don't want to lose because it's earmarked for something specific in the future. A lot of our clients say, I'm saving for my kids' education. I'm saving for a lake house. I'm saving to make a new investment in a business. However, investments by definition are investments by definition are things you can afford to take risk with. And risk is the possibility of loss. So when you think about investing, that's money that you can't afford to lose in the short run. And you've really got to separate the two because they're very, very different. So again, savings is money you can't afford to lose, you don't want to lose. Investing is money you can afford to take risk with. And so what I want to focus on today a little bit more, and Jim will get into how we can utilize it for investments. But what I want to do is focus a little bit more on the savings component. Because today, more than ever, people have realized that savings is an important part of your strategy. Jim, one of the things people tell me all the time is, Justin, what do I do? My portfolio is down 20, 30%, 40% in some cases. What's the first thing I can do? And the first thing that I tell people is you've got to understand what season of life you're in and where you are. You need to have 3 to 5 years of money in a savings vehicle, at least, at minimum. And I would hope you would have a lot more than that. But what that does is it gives you a comfort level that you don't have to sell your investments at the worst possible time. And I tell people this all the time. If you don't have a savings strategy, if you don't have a plan, that's what's going to protect you as we come out of this for the next crisis that we go through financially, whether it's a dot-com bubble like 2000, whether it's a financial crisis, or here we have a healthcare crisis that has totally shut down our economy. Jim, our mentor, Nelson Nash, used to tell us, where money is, opportunity will find you. And so being able to have a savings vehicle allows you to be in a position to weather any storm and take advantage of those opportunities when they come. So I want to look through that for a minute. So I want to move kind of quick because there's a lot of information we want to cover tonight, but I ask people all the time, if you could wave a magic wand and create the perfect savings tool, the ideal place for you to save money like we talked about before, what are the things you would look for? And Jim, it always comes back to 5 or 6 of the same things. Number one, they want a competitive rate of return. So they want to be sure their money's earning and is competitive. The next thing they want, if they, in a perfect world, is they would like to be sure that that competitive return is guaranteed. You know, if we could wave a magic wand, that'd be a great thing. But it grows every day, every week, every month, every year. Obviously, the next one you guys can read as easy as I can is they want it to be liquid, where they can get to it when they need it. Again, in a perfect world, they want it to be tax advantaged, creditor protected, so that for a lot of our doctor clients that are on here, or business owners, that you can't get sued and lose it. It's protected from creditors. And then, of course, one of the things that, Jim, I'm excited you're going to talk about, we call it uninterrupted compounding. You may not be familiar with that, but I promise you by the end of the evening tonight, you're going to understand what that means to you and how important it is. So let's get started. The first place I want to talk about is the number one place people are saving or investing money today. And I say that because they're vastly different. We do a lot of work with AT&T employees, and they have a 401k plan that's called the AT&T Savings Plan. But what's interesting about that is there's not one, based on our definitions, there's not one savings vehicle among it. It's truly an investment plan designed for your 401k and your IRA, but it's called the savings plan. And that's why I want to be sure tonight that you understand there really is a difference between the two, and you're going to understand how to use those after this evening is finished. So, Jim, if you just looked at it, this is where $18 trillion in our country today, $18 trillion people have invested or saved in their 401k plan. But based on our criteria that thousands of people have given us, you only get 2 of the 6 that we're looking for. You get a competitive return, hopefully. You would argue that over the last 5 to 6 weeks, but over time, you have an opportunity to get a competitive return. Obviously not guaranteed. In most cases, it's not liquid unless you can qualify between that magic window of 59.5 and now 72. It's obviously not tax-free. Most states it's creditor protected, but you certainly don't get uninterrupted compounding, meaning if you take $1 from there, that dollar is gone and what it could earn for you. So this is interesting to me, Jim, because, and I want you guys to understand this, this is the number one place people are parking money today, yet it checks only 2 of the 6 boxes. Jim, I use this example. I'm gonna see if you'll be a guinea pig for me. Let's assume I've got a business opportunity. I want you and I to be partners, okay? You with me so far?
Yep.
Jim, I want you to put up all the money, okay?
Yep.
You good so far? I want you to take all the risk. I want you to take all the risk. I want you to manage it or pay somebody a fee annually to manage it. And then I'm going to come back in about 20 years and see how good we did, and I'll let you know what percent partner I am. You interested in that business?
I'm not. I like it, Justin, but I'm not interested in that deal.
Here's what's amazing to me. If you really understand it, there's $18 trillion parked in that business right now because not one of us knows what tax bracket we're going to be in when we retire. And we're putting up most of the money. If there's a match, you need to take advantage of it. But I'm talking about those dollars above and beyond that match, or dollars after tax dollars that you're contributing to IRAs. Great wealth accumulation tools, but again, the variables have changed. The dynamics have changed. Back in the 90s and 2000s, that made a lot of sense because tax brackets were going down. Interest rates were much higher. It was a totally different economy than it is today. Let's go to the next one. CDs, savings accounts. Again, I'm going to move quickly. Obviously not a competitive return, but they are guaranteed by FDIC and they are liquid where you can get to them. Jim, there's $10 trillion parked in savings accounts and CDs and money markets today. Again, not as efficient of a place, as maybe we would want, only 2 of the 6. Let's move to bonds or mutual funds or non-qualified type of accounts. So again, of those perfect 6 that most everybody wants, Again, we're only 2 of the 6. We got a competitive return and we got liquidity. So Jim, I want to pause here for a second because what I think is so key, and the point that I want you to take away is, where is our storehouse? Jim, our mentor, Nelson Nash, who you and I both know, he's the author of this book. I'm going to hold it up right quick. It's called Becoming Your Own Banker. I'd love it for everybody out there that's on tonight with us to copy of that book. It's really a workbook for a 10-hour study that Nelson would do live in person. Some of you guys on here have heard him. I had the privilege of probably hearing 20 of those. But this was his workbook, and one of the things he talks about in here is understanding where you store money. Where's your storehouse? And before we go into the next slide, Jim, it really reminds me of a great story from the Bible. If you haven't seen it, guys, I'd highly recommend reading it. Starts in Genesis around chapter 41 and goes through chapter 47. But it's about Joseph and how God came to him and said, right now times are good, okay? Things are going well. There's an abundance, but there's going to come a time when there's a famine. So I want you to store up in the storehouses. I want you to store the grain and the wheat. Store up for the famine. And when you do, you're going to have immense opportunities. And sure enough, Joseph was able to do that. And what you'll find out through that is people came to him and to his storehouse. Just like Nelson said, where there's money, there's going to be opportunities. People came to his storehouse, and he had the opportunity to make tremendous financial gain for himself and his country because he had the right storehouse and he understood the economics of what was going on in Egypt at the time. And that's what Nelson told us when we talk about having the ideal storehouse place to store our wealth. When structured properly, and Jim's going to get into this, we have a savings tool that can give us a competitive rate of return. However, Jim, what does it say on the second page of your properly designed life insurance contract that you have?
Tells me the guarantees that my policy is going to grow every single day.
So it's hard for guys like Jim and that word guarantee, but there are actual contracts that give you guaranteed growth inside of your contracts when they're structured properly. Number 2, the second line underneath that tells you that they're liquid. You can access that money. You're number 1 in the food chain. You have access to your capital or the insurance company's capital. And Jim's going to walk through an example of that. And that's really, really important because it opens up the door for those opportunities. By the way, when structured properly, your money grows tax-free. You can look it up in 7702 in the IRS code. It is creditor protected. And the thing that is really important to me that I want you to remember is the uninterrupted compounding that comes with a properly structured life insurance contract. It's based on the book, Becoming Your Own Banker. It's known as the infinite banking concept. And it has made a big difference for me and my family, as well as Jim's. I've been practicing this for our savings component now for over 12 years. And we've utilized it in many different ways. And I actually just found this slide yesterday, and I wanted to share with you about why I've chosen to utilize this for our savings tool. So this is a graph for you, and what you can see on here is the little yellow-orange line is the bond index over the last 20 years that we've been talking about. And I think that blue line is the stock market index. And what you can see is where we are today is they're almost dead even. And my point in telling you that is what I've chosen to do is partner with insurance companies for the bond portion of my portfolio, for the safe money portion of my portfolio, because insurance companies buy more bonds than anybody in the world. They're the best at it, and they get discounts that you and I as individuals can't go out and get. So I've chosen to go in partnership with these mutual strong insurance companies that we talked about to create a system that allows me to grow money in a tax advantage way, that's guaranteed, that's liquid where I can utilize it. The reason that I want to utilize it is because it's going to create opportunities. And again, I go back, it's not just Jim and I saying this, but here's David Walker and a quote that he gave us just a few weeks ago, where he says for his family, he has chosen to utilize a significant portion of his retirement savings, keyword, to purchase products from financially strong insurance companies. Why? because he knows that the variables have changed from where they were 20 years ago and 30 years ago. And by understanding that, it gives you an opportunity to create wealth. Just like Ray Kroc did with McDonald's. If you ever read the book or go see the movie, you'll see he had a properly structured life insurance policy that he utilized to get McDonald's up and off the ground. No different than Walt Disney, the exact same thing. He could not get anyone to invest in his vision, so he utilized the cash value from his life insurance contracts to build Disneyland and turned into what it's turned into today. So Jim, I want to pause here and just turn it over to you, because the thing that's most exciting to me is we've talked about how to save money and how that helps us as we come out of a recession, as we come out of a crisis. But what I want to do is turn it over to you to show people how it can open up the doors of opportunity.